Larry, I don't know how what this China-U.S. trade, which is now seems to be easing, and yet it may actually flare up again, means for your investment strategy.
Well, as an investor and as someone who's active in the markets, there is this phrase that's come along that says that we don't take Trump literally, but we certainly take him seriously. And I think there is an issue here, which is that we've seen it in the negotiations on trade with other countries. We're seeing it, I think, now with China. We've even seen it around the Iran deal, that the rhetoric is worse than the policy. And I think that's the way markets are responding right now. They are relatively, I would say, relaxed about these sorts of issues, thinking that the opening salvo of something that looks like a trade war ends up being negotiated back into some kind of an agreement. Whether it actually fundamentally changes much, only time will tell, but that the actual outcomes are not as nefarious as the rhetoric seems to be. And I think this is another example of that. And so to some extent, there is, I guess, an understandable degree of acceptance that this may be a novel way of doing things, but is not actually going to change things all that fundamentally.
Is there a buying opportunity?
I'm not sure about buying opportunities here insofar as the market has not moved that much anyway. I think it is probably about seeing through some of this rhetoric and then asking one's more serious sort of, I suppose, fundamental questions about what's happening here to growth, what's happening to earnings. On the growth front, the concern isn't so much that trade or trade spats might themselves have material impacts on growth. It's much more about whether it affects sentiment, in particular business investment spending. A little early to tell.
Well, at the same time, so Germany is blaming trade, right? As the economy cooled a little bit more than forecast. I think GDP rose 0.3% in the first quarter. So are there countries that will be impacted by trade? I don't know what you call them, if it's concerns or tensions or, I mean, we're not at war.
I think it's too early to sort of say that the first quarter data were really that hit by, say, these sorts of uncertainties. After all, weather effects, even the flu effects and some lost work days and so forth played a role there. There's also big problems in first quarter data everywhere in the world in terms of seasonal adjustment. So I probably wouldn't go too far with that particular statement, but it is the thing to watch, right? Because CapEx is coming back globally. I think there's very little doubt about that. There was an acceleration the second half of last year. A lot of it is around tech, of course, and it's for understandable reasons in terms of innovation plus capacity constraints. But CapEx is always driven by expectations of the future, right? It's not driven by the cost of capital nor even by the return on capital. It's about whether the future is going to be better than the present. And that's the real issue about how trade could affect the economy. So it's worth watching. It's just too early to draw conclusions, I would say.